Dennis, we're pleased to have you on this morning. It is the great debate. Do valuations matter at all with the way that the market is structured right now?
Yes, for sure they matter. I just think that way too many people put too much emphasis on valuation metrics that don't necessarily correlate to returns. And I think that's a really big problem within the investment business right now. What you need to focus on is relative valuations. And so when your risk-free rate is pinned, and right now roughly 61 basis points on a 10-year basis, and inflation expectations are running 1.6%, so your real rate is deeply negative, and economic growth over the cycle is expected to be 2% on a real basis, 3 to 4% on a nominal basis. As long as that backdrop persists, where you have an anchored risk-free rate relative to nominal GDP growth, stocks, all things equal, are attractive unless you can make an argument that margins are going to collapse. Bottom line.
Yeah. And we talked yesterday about negative real yields, and it's it's one of these terms you throw around to sound smart at, I guess, virtual cocktail parties now, Dennis. The reality is this: if you own government bonds, for the most part, unless you get massive capital appreciation, you are losing money adjusted for inflation. But yet people keep buying bonds, Dennis. That's the hard part to understand.
Yeah, and I think there is a logic to buying bonds. Mostly, and this is not talked about enough, as a deflation hedge. At some point, it won't make sense, but there is a chance, as an example, let's just say the virus mutates. Let's just say that death rates go from 1,000, which are bad overnight, and you already mentioned, to something much larger, and we have a much worse economic scenario. Then there is the chance of a deflationary spiral. And if that happens, right, if that were to happen, your only real hedge against that is default-free government risk. And you really only have three choices for that, which is JGBs, German bonds, and U.S. Treasuries. So they're more of a hedge at this point against tail risk. The other side of that barbell is long equities.
Yeah, I mean, look at the 10-year yield this morning. It is below 0.6%. I understand a lot of insurance companies and everybody else, they've got to buy bonds no matter what the yield is, just because that's the way they're structured, because their job is to preserve capital, not necessarily grow it. But if you buy a bond, you're probably saying, okay, I'm going to sacrifice any real yield. I might even be a little bit negative. You can buy equities, get a little dividend yield as well. Microsoft is probably not going out of business anytime soon. But at some point, if you get to 25 or 30 times trailing or forward earnings, do we even have to look sideways at the stock market? At what point will valuations matter, Dennis?
Well, I think they will matter when, the way I would think about it is, when is your cash return yield on an expected basis? When does that cash return yield move into an area that is just much less attractive? And the best we could do is show it historically, by the way, much less attractive relative to risk-free rates. Right now, your cash return yield, which includes dividends plus buybacks, as a percentage of net income, and if you project that out a number of years, the stock market looks tremendously attractive relative to risk-free rates in the 80th percentile historically, because of the name you just mentioned, Microsoft, but throw in Apple, Google, et cetera, all the names you know. At some point, that valuation will normalize. It'll normalize one of two ways. Either those names keep on going up, or risk-free rates come higher. And at some point, when you get, say, let's call it the 50th percentile, and by the way, I'm giving you a false sense of precision. It could go lower, could be a little higher than that, but let's call it the 50th percentile. Yeah. That's when you're going to go sideways. And we're not that far away from it. I would call it 38 to 4,000 on the S&P. And at that point, your returns, all things equal, centers per risk, are going to be less attractive.
But you said that right now that the stock markets look, I think you said, tremendously attractive, Dennis. Tremendously?
Relative to risk-free rates, absolutely. Absolutely. I mean, there's
Is there any other place to invest besides equities that makes any sense right now? Cash, gold, baseball cards, anything, Dennis?
I would say relative to your high, stable cash returning stocks right now, the answer to that is no. Given the information I have, I would have to take some change of information. If things get much worse from a virus point of view, or something happens from a trade risk for when I'm talking about something much worse with China than what's currently going on, then
but as
yes,
you guys at Evercore see it, as you guys see it right now, Dennis, the equity markets are still a good investment. They are fairly priced relative to risk rates, and
yes,
will probably keep going up.
Yes, and that's the uncomfortable truth for people, because it does seem odd that multiples this high mean that the market can keep going higher. But every asset allocator around the world, every sovereign wealth fund around the world looks at this on a relative basis. And that's what matters.